Well, welcome to the video. This is already about the 10th chapter of the book. I'm actually recording this intro after I've done everything because there were quite a bit of oscillators in here which required some calculation, which actually wasn't expecting. Thought it would be easier. Turned out it was quite difficult actually. So that's why I'm recording this now. But basically, you can combine oscillators with moving averages in case there's a choppy market. So you can ignore these oscillators in the case there's a breakout, and you should follow the moving average so you can really figure out what to use and what point. Yeah. So a lot of these oscillators actually use like a midpoint, like a value of 0 or a value of 50, right between 0 and 100, to really showcase if something is overbought or oversold. Something to take note of, I guess. And yeah, well, I'll talk about the momentum, the rate of change. There's actually also something which you just use two moving average to indicate whether a price of is good for a buy or good for a short. And I'm going to talk about the commodity channel index, the relative strength index, the stochastics. I'm not going to talk about Larry Williams, but he is something. It could be interesting. He was a good trader, the internet said. But this thing looked kind of difficult, so yeah, I'm just not going to go into it. Then we have the MACD, which I think is one of the better ones to use whenever you're trading. And the contrary opinions, basically. So, well, yeah, that's it. Here it is again. I just had to make some calculations because I saw the rate of change wasn't actually the same, but it's almost the same. So basically what happens, let's first get into the momentum line. Let's say we take this day, of this hour actually, and we take the current closing price of 1231.6. Difficult to show you, but I wrote it down in this one here. Should look at this one. So we have the closing price of 1231.6. Now the momentum line is put at 4, so it means 4 days back. So we go 1, 2, 3, 4. Now we can see the closing price is 1212.69, and that's what's written here. So now, if we subtract that from this one, it's going to be the momentum is 18.91. And indeed, if we look at this day, we get 18.91. That's cool, right? Well, the problem is with momentum or rate of change, if there's like a sudden spike, so let's say this fourth day was actually like 10 times as big as it is right now, it would have a spike, sort of, or like it's lower. So it is susceptible to any sort of vibration or like stuff. It's susceptible to that. So if there's any like a really high close and a really low close again, you know, it's gonna have problems for the two next momentum lines, right? And well, yeah, sorry, let's go to the rate of change. It's almost the same, but instead what you do is you divide by the days, the same day of the days back again, so 12.69, and then you're left with 0.015. If you do this times 100, you get 1.56, and indeed it's 1.56% increase based off of this day, and you can check it yourselves, but that's really the truth. So hey there, this is just a bit about the commodity channel index, and as you can see right here, this is the formula, and it doesn't look that difficult because you take the typical price and the amount of days you're using, and you also want to subtract the simple moving average of the amount of days, of course. So in this example, we're going to use 3, but also you can use anything basically, and of the typical price as well. Typical price is the high, the low, and the close of a price. Because if you go to the next price, the open is sort of the same as the close from the previous one. So you can still take all 4 and divide them by 4. But in this example, with the CCI, they use the high, low, close. So we are also going to use the high, low, close, right? Because why wouldn't we then? So, and then all you need to do is divide it by the 0.15 times the mean deviation. And I'll go over it. So basically here we have 3 numbers. This is a typical price. This is the price of Ethereum, and I will go over it in a second. But basically just take these numbers. This is those 3 numbers added together and divided by the amount on which they are, right? So in our case it's 3, but if you're using 5 numbers it will be 5, right? It's just divide by how many times like the number itself, Right. The next thing what you're going to do is the mean deviation. This is the difference between the moving average of the current day. So this is the last day, and this is like the 2 days before. So let's say this is today, this is yesterday, and this is 2 days ago, the day before yesterday, right? And you will basically just subtract this from this one, and here it is this from this one, and here it is this from this one. So you can see here's A3 minus B, and here's A4 minus B, right? So you get that one. Now we actually got the sort of the average deviation. I can type it here, but it doesn't really matter. But now we have the average deviation of 34.355. Why? It sums up everything into C and divides it by everything. Right? I could do C as well, but it's just it's the same amount, right? So then we get this number. Now, to get to the mean deviation, so the average mean deviation, you want to times that times 0.015. So we get 0.51533. This can be rounded up to 2 decimals, probably I think it's best, but we're using whole values. So that's why we get that. Now we just need the last part, which is basically going to be, we need to divide C2, which is going to be the mean deviation of the current day, divided by the mean average deviation, which is going to be, so the mean average deviation times 0.05, which is this one. You will end up as 100, right? Because 51.5 divided by 0.5 is going to almost double, or more than double. I'm not sure why it is. No, less than double, sorry. Yeah. And then you end up with 100. This is pretty cool for a 3-day moving average, but let's try 8, which is going to be the exact same, and I'll show you in the video a second. So basically what it does, it takes all the numbers again, and now we're left with a bit of a lower moving average. We get more mean deviations. This is the mean average deviation. We times this by the same amount of C11, right? And we divide that again. And that's basically how you get the commodity channel index. And I'll show you in the right. So there we are again with the example we just saw. And basically the first one, this candle here, is going to be this candle because you're moving backwards, and it's not necessarily lagging, but of course you can't know the future, so this is like the starting point. So basically we'll take the starting point, and I just used a simple moving average with a high, low, and close of 3. This is also the open, but we're using high, low, close of 1. So it's only looking at itself today, and that's how you get sort of the typical price of the current day. You can't do it out of your head, but it takes a lot of work, and this is just easy. So that's the purple line. Now you can already see the moving average is 1445.165, and you can see it as the blue line as well because that's the 8-day moving average. But basically what it's done is have averaged every typical price of the last 8 days, added them together, divided by 8, and then you get this price. That's just a necessary part of the calculation. Now we're going to go to the mean deviation. So from the same thing happens. So every time we're going to subtract 1445 from these numbers. So you're left this. Now you're left with 25.11, right? Because of the mean deviation. You times that times the 0.015, and you divide the mean deviation from the, was it true? Mean deviation from this amount, and you will be left with 224.97. And if we look at the number, we can see 225. All right, so that's pretty. It's not that difficult, but that's pretty much. So, well, this one took me actually quite a bit longer than I was hoping, because I can't seem to figure out the exact phase of RSI, but the calculation is correct. The thing is just in trading futures, like its own oscillator or something. Like I'm not sure where it's getting the data from because I couldn't get the exact values as I have right here. But I'm just gonna explain how I got into it, and then afterwards I will go over stochastics, which is another trading strategy. So yeah, let's get into the RSI. So basically the RSI is a relative strength index, and it's relative to whatever it was in the past. This example uses 5 values, or 5 values. So it's relative to the 5 values in the past. So what it does is this. These are the closes of the price of Ethereum, right? So the past 6 closes, and you need 6 to get 5, right? Because it's sort of lagging behind, and it needs that one more data to actually know what the difference is between the current one and the one before that, right? But you're not really doing anything with it, but you need it. That's the part of the thing. Now here is sort of the difference between these. So you can see here, it's the A2 minus A3, and it's done this every time. So basically what it does, it checks the value and subtracts it, and that's what you get. Now, if it is an upside value, you just want to display the up value. You don't want to display it if it's a negative value. And if it's a negative value, you actually want to display the absolute value, because you won't be using the negative values, otherwise it will mess up the formula actually. So now this is the average of everything in the upside. Right, so that's come at 4.228, and now this is the average of everything in the D6. It is, of course, everything combined divided by 5. So you might wonder, why is it that low? Well, it's because the average, right? Now we need the relative strength, which is actually just the average up divided by the average down. So now you have a relative strength. So you can already see 20.75. Now all you need to do actually is add 1 to the G2, which is 20.72. So you're left with 21.72. And you need to divide 100 by 70 or 21.7. If you've done that, you need to actually take 100 and subtract that number from it, and you'll be left at 95.39. This is not the exact same value as in TradingView, but I'll show you in a second. But basically, this is the formula. You can use whatever that you want. You can also sort of break this one down, but I haven't got the right thing here, but you can. That's a good part, you can. And it was basically RSI. It's a really good indicator, and most of the time it uses one RSI line, and it could also take like one RSI line with 14 and 28. So you can see sort of the slower moving, the faster moving one. Now the next one is going to be stochastics. Stochastics was much easier actually compared to the RSI, because I could just see the values in TradingView, which is much easier. So imagine this is one bar, this whole value. You will take the current close. This is a single bar, by the way. You can actually, I'll get it in a second. So this is one bar, right? The current close is 1224. The lowest low it went was 1213. The highest high was 1228. So, and the lowest low again is 1213. Now you need to subtract this from this one, subtract this from this one, right? So you get something. Now divide these values from these values, these, and times that 100. You will get 69.51. I'll show it to you in a second. So that's basically it. You have a stochastics of 69.51. It's overbought if it's above 70, so that's good to know. And here, literally the same happens, except these ones sort of like a weaker candle. It's almost oversold, but this one is literally based off of its own candle. Now stochastics actually uses most of the time uses two sort of values, just like RSI. So basically, this is the fast moving average. These two are the fast moving average. All it does with the slow moving average of D is actually take the average of these two values, and that's it. That's it. And you can really take these up on yourself. But basically, what it means is this one. You have one. It's going to look at only itself on one bar for the stochastic, so every time. You can also take two, and then, for example, the current close will always be the same, right? Or like depending on the number. But let's say the close of the second bar was actually lower than the first one, but the close of the highest high of the first bar was actually higher. You will take these two values. So that's how you really can calculate 14 things. So you can really expand it onto like whatever time period you want. Right. So that's pretty much it. I'll just get to continue with stochastics because we ended with that. So basically what this does is we have only the bar itself. So just like the values here, so I use this value. You can see the lowest it went is 1213.27, and you can see whatever happens, right? So now if you were to take two candles for the first setting, you would actually look at both candles and take the values which apply to them. So for example, this, you always need the same close, but this low was lower, so you would use this one, and this high was higher, so you will use that one. So that's how you can sort of expand the theory behind it. But for this one, actually, you can see we get 69.51, and you can see it in the blue value on the left side on the stochastics thing. It's 69.51. It's right here. So if you look at it here, You can see it's 6 out of 5 one. Now, and the same happens for the previous bar, which is going to be 36. That's 4 4. So that's quite an easy one, right? And now we use the average of these two to get the current stochastics bar. So you can see this one is 52.98 and this one is actually 52.98. So that's good, right? This one is actually quite easy to calculate, but don't do it, or like use some code or something if you want to calculate this one, because this will take time. Like you have to, I did it just because I was only using 2 examples out of my head. But if you're using like more than 14, which is most of the time the basic thing they use, it will take a lot of time to do manually. So take care of the use the or code or whatever you get, right? Or just use the indicator, it's fine as well. Right. This is the RSI, which we've gone over already, but I just want to show you with some examples. So here we have it, yes. So basically this RSI is based upon the 5 previous values as well. And just as of here, you can see this value is actually, where you need to look at the purple line, 86.23. Like it's not even close to 95, and I need to check. So we have a close of, oh, sorry, it's this one. Yeah, sorry, this is the one. So we are at 91.26, but still you can see it's off, right? It's still off. And I just could not get it to be the perfect exact number as I got on the screen. But as you saw in the formula, this is the correct way. So I wasn't sure what I did, but what I did find out when I was using only a 2-day moving average, if you have a down of 0, you will divide by 0, which literally is not possible. So you always get 100, right? Because 100 divided by, or 100 minus, what was it? Nothing is still 100. But this one never reaches 100, and I was not able to find out why it didn't. But yeah, I guess we just have to accept it. Maybe I'll look into it later, but this was like, I've been searching all over, but I couldn't find it. But yeah, that's past 2 oscillators of this chapter. Finally, actually. The first one is being the Larry Williams, and I'm not even going to go over it, to be honest, because I was looking into it and I was like, yeah, I'm never even going to use this one, so why would I put any effort into it? But it's apparently one moving average with RSI combined, something. What? Yeah, whatever. We're going to go into the MACD. So the MACD is basically, this is the formula. And what it is this. So you will have the exponentially moving average of 12 days and exponentially moving average 26 days, and subtract that, right? And now this is a MACD line. That's the MACD line. And now to get the signal line, or like the fast line, like what they call it, you would have to get all these values of the MACD line, and this one uses the 9-day moving average, but you can use 3 days or 5 days or like whatever you want, right? I believe, at least that's, I'm not gonna go and test 9 days because that was horrible. But this is the formula. So what can we see? We can see, I first of all thought it was like really simple. It's like it was just these lines put into here, but it's not actually. It's just a tad different. Because as you can see, this one actually is coming up here and this one is actually still going down. Which, well, it's quite important to know because this one will create immense, like a lot of different signals compared to this one. So what I've done is actually tried it in Excel again, and to be honest, this one was, I thought it wasn't difficult, but I still couldn't get the exact numbers. But yeah, let's go over it. So basically what you want, as we saw in the formula, you want the closing price of whatever you're doing. So I took the closing price of these consecutive 4 days, so 1, 2, 3, 4. So you can see the closing price of 1566.1. Now the 12-day moving exponential moving average is 13,742. As you can see, is the yellow line, and the blue line is the 26-day moving average. Now, all you need to do to get the MACD line is actually subtract that from each other. So you get 16.95. And you can see in the, I'll point it out here, this blue line here will become 16.95 if you look at it. That's 16.95. So that's actually the MACD line. Now all we need is the signal line, because the green one is actually the difference between the signal line and the MACD line. And I could not get the signal line. I really tried, but as you can see, there's a right value right here, This is the 3-day moving average. So it took these three values, added them together, and divided them by 3. So I got this value. So that one is, they got 3.75. I'm not sure why. And I got 1.685. Right, it's just different. And if you go one day before that, I get 9.29, and they get 9.45. So it's just off, right? It's just off. And I'm not. I thought it was the smoothing, which is supposed to be 3. But then again, I tried everything. I couldn't. So just like the RSI or the, what was the RSI? Yeah, I think so. No, yeah, the RSI. Sorry. I can't get the exact value, so I'm guessing they use some kind of other value or something, but I'm done. I don't want to do this anymore, so this was the best I could come up with, right? So that's kind of the math behind this one. Now, to get over the last parts of this one, why oscillators are useful? Well, they're good during choppy markets, right? And you can compare them to moving averages to really get anything else. So that's actually why the MACD line is an oscillator, and the moving average you can see on the screen are actually moving averages. So you are even allowed to ignore oscillators during breakouts because, well, they will create false signals, right? Because it's a breakout. So of course, well, they won't create false signals per se, but a breakout is going to have extreme values, but it could just be a breakout and cut you to the top as well, right? So you could go for a short when it's breaking out to the top side, and you get completely washed. So now another important thing is contrary opinions. Basically, he talked about how hedgers are always right and the crowd is always wrong. Yeah, that's sure. Maybe I'm not sure if whales are good hedgers, but like I'm not sure where to find the hedgers. But there must be some companies who publish their portfolio or something. Right? I think so, at least. Yes. So basically, let's say you have 80% things of the people think it's gonna go down. It's gonna go to the downside, and 20% of people think it's gonna go to the upside, and nothing happens. What does that mean? It means that the 20% of people is actually as strong as the 80% of the other traders. So they hold huge positions. So that's also something to really worry about. If everyone is overselling, well, you should go the other way, right? Well, sometimes it's a matter of it's most of the time it's a pretty good choice. Sometimes it's not. So really be careful with that. Right, and then the last one is investor sentiment readings. It's about intelligence numbers, so people, like, you can ask people what they think is going to happen, and they actually tested it, and most of the time it's good to just go the other way. So let's say if 60% of people think it's going to go to the upside, you should go short, and it was pretty funny to read. And that is pretty much it for this